All right. It looks like Polymarket might be emerging as one of the killer apps in the crypto space. It looks like the job market is really cooling off with lowest numbers since 2021. We'll dig into all of that. US economic activity is still contracting. The manufacturing data was some of the tightest and weakest we've seen in a few years, right? We're going to talk about what an inverted yield curve actually means and what you might expect for the flattening of an inverted yield curve in the coming months. We'll break all that down. Uniswap settles with the CFTC in the United States. And we'll take a look, of course, at some of the tech news in AI. We've got some interesting drone news that I've been following. iOS 18 with Siri Chat GPT integration. We'll have an update on that. And it looks like Qualcom is working on a mixed reality smart glasses with Samsung and Google. We'll dig into all of that and more. All right, gang, it's time for Money Talks. Okay, welcome to another exciting episode of Money Talks. I believe we're up to episode 5. Wow, all right. I just want to remind you that any views expressed in this show, any information presented should not be considered investment advice. The show should be considered for entertainment value, informational purposes only. Please do your own research, make your own investment decisions, and have fun and enjoy. All right, let's get right into it. Polymarket. Polymarket seems to be an emerging killer crypto app. Bloomberg, the Bloomberg terminal, which is really the gold standard in trading in financial markets, macroeconomics, has integrated Polymarket into its data feeds and famed Bloomberg terminal, right? So the Polymarket is a crypto-based prediction market platform where users buy and sell effectively tokens or shares of a bet using crypto to bet on the likelihood of any future event. And right now, the most important or most, I believe, voted on / betted on future event is the 2024 presidential election, which is currently showing about a 7% lead for former President Trump over Vice President Harris, 53 to 46%. Super interesting. I think that we're going to see a lot more of these applications like Polymarket. As I said last week, by the way, Vice President Harris gave her first interview on CNN. And we are, I believe, 5 days away from the first, potentially only presidential debate, given the disagreement that they're having over the format for future debates. I think the Harris campaign is very upset. They did not want the mics to be muted. I don't understand, but whatever, they can do what they want. Super excited for the debate. We'll see how that goes. And really going to pay attention to Polymarket. Would love to have the Polymarket team here on Money Talks at some point to dig in on how everything works. It's an Ethereum / Polygon based application. Super cool. Let's get into a little macro news. We'll come back to the election towards the end of the show, but it looks like job openings have cratered to their lowest level since 2021. So last month, after the latest JOLTS report came in fractionally stronger than expected, and it looks like the Biden-Harris Department of Labor has engaged in its usual data manipulation. This time, they've artificially inflated the number of government sector job openings. One report I saw made a prediction that they expected a big drop in the next job openings report, as the recent surge in government job openings simply seemed to disappear, right? And of course, that's precisely what happened, because yesterday, the Department of Labor reported that in July, the number of job openings plunged sharply to 7.67 million, which was the lowest since January 2021, from a prior month unrevised June report of 8.2 million, which of course was revised sharply lower to 7.9 million, which also means that was originally reported to be a beat, right, to estimates of 8 million print, has since been revised to a miss of aforementioned 7.9 million. Of course, 1 month later, nobody cares. And that's precisely how the Biden-Harris Labor Department has been operating all along, basically doing these bait and switch data reports to make the economy seem significantly stronger than it really is, also failing to mention that the vast majority of the new jobs are in the government and not in the private sector, which significantly contributes to increased debt, increased debasement of currency, increased inflation, et cetera, et cetera. In any case, since Wall Street was expecting a much higher number based upon the unrevised print, today's miss was massive, and it printed below even the lowest of the estimates. It was a 4 sigma miss for those of you who track macro. 4 sigma miss to the median estimate of 8.1 million, which is a whopping 427,000 jobs in absolute terms. And it looks like a driver behind the latest months of manipulated beats, which as we've shown in the past was artificially inflated, was again the number of government sector job openings. And as expected, this tumbled from 1.0 million to about 924,000, while private sector job openings hit a fresh 3.5-year low. So as an aside, we'll keep an eye on construction jobs, and the number of job openings in this sector is an absolute free fall, plunging to levels that we haven't seen since late 2020 when we were in the phase of the COVID pandemic lockdowns. Okay, so I track the DXY as kind of my absolute measure for market liquidity. It has, kind of been doing its methodical march, downward. Nothing goes straight down. But if I look at the DXY chart, the daily chart over the last 6 months or so, we peaked at 106, and today we are right above 101. Right, so. I told you a few weeks ago, and I tweeted it out, that a break below 103 or 102 was a clear sign that the market was now pricing in rate hikes and rate cuts and increased liquidity via both the Fed, the Federal Reserve, and Treasury. That now appears to be being priced into the markets. Gold is near its all-time highs, trading at about $2,516 and change as of the recording of Moneytalks. The Dow Jones is, maybe a couple of percent, off of its all-time highs. Again, seems to be, more or less an expectation that while we're not quite in recession, we are going to get injections of liquidity into the U.S. system. At the same time, the recent measurements of manufacturing have come in, with pretty bad numbers. The ISM monthly survey of purchasing managers showed that just 47% reported expansion in August, above the July reading, but below the consensus forecast. And this, yet another weak economic reading, raises the probability that the Fed will be cutting interest rates by at least a 0.25 percentage point later this month. But the dot plot seems to be now showing that a 50 basis point cut is now even more likely than a 25 basis point cut. And given that the prevailing wisdom has been 25 points, if we get a 50 basis point cut, it should be very interesting for markets, because I think we're going to see a lot of volatility. We could see an initial sell-off out of fear, and then a spike in risk on assets after that if we get increased liquidity without the immediate specter of a recession. However, U.S. economic activity is still contracting. Let's be crystal clear on this, right? And I think this is potentially setting the stage in the coming months for a pretty severe recession. And so while the ISM manufacturing PMI came in at 47 yesterday, which is not quite in recession territory, this economic activity survey still points to a pretty severe slowdown, which again, in normal historic terms, does raise concerns about an incoming recessions. Normally, recessions happen when the PMI is below 45-ish, right? It's not a guarantee, it's a range. So the current PMI level of 47 isn't in historical recession territory yet. So we can take, if we go back to the past, we can take 1995 as an example, right? The PMI was at the same level in 1995 at one point that it's at today, and the S&P 500 continued to climb into 1996, into 1997. We all remember what was happening in the dot-com era, which was driving massive increases in productivity. The integration of software into everything. Software was eating the world. However, the reason you can also point to the stock climbs was that no recession actually materialized, kind of a self-fulfilling prophecy given the increases in productivity that we were seeing at the time. So that's the risk if you become bearish too soon in these models, right? If you don't have confirmation signals, right, it may look like you're heading towards a recession, but if it doesn't materialize, you're going to miss, and you try to time the market, which most of you shouldn't be doing, you're going to miss run-ups in risk-on assets like stocks and now, of course, crypto. And anyway, in other words, there could still be upside potential if a recession doesn't hit either until late 24, sometime in 25, or potentially never, right? So while I don't expect necessarily a 95 repeat, it does highlight the importance of, again, timing a recession if you want to, if that's how you basically make your stock bets. I wouldn't necessarily recommend that for everyone, especially if your time horizon is forever, like mine is when you're making investments. But the S&P 500 could still have significant upside in the coming months and year, depending upon when the recession really begins, if it does. Okay. And again, when I say if a recession appears, I'm talking about how the government reports it, how the media reports it. I'm not talking about reality. Reality doesn't really seem to matter much anymore. What really matters is, what is the government telling us? What are the macro talking heads telling us? And they're telling us right now we're not in a recession. All right. But again, to make the case, and then we'll move on, right? Financial conditions have been tight for years now, right? Now, history doesn't necessarily repeat, but it often rhymes and leaves clues, as they say. And so these financial conditions or the tight conditions, I should say, feel similar to what happened in 2008 and what I've read, since I wasn't there, in 1929. Right? But keep in mind, of course, as the saying goes as well, markets can stay irrational a lot longer than you can stay solvent, right? So let's dig into what that actually means. The Fed's dual mandate requires them to focus on two things, right? Labor and inflation, right? The labor market is clearly heading in the wrong direction after being very strong, at least on a reported basis, but actually not as strong as they wanted us to believe on an actual basis, right? The unemployment rate and jobless claims have been steadily rising, and the aforementioned previous jobless reports are being reset to the downside on an as-we-go basis. Now, on the inflation front, core inflation dropped throughout 2024. It's been hovering around, only about 0.1% month over month. This is way below the 0.3% average of the last few years, and it's more in line with pre-2020 levels, right? So, and Trueflation, which I strongly encourage you to follow on X if you use Twitter, is a great guide for what the reality of inflation really is. And we're not in a deflationary environment right now, but we could be headed there if commodity prices continue to collapse, as it looked like might be happening. But both employment and inflation data are clearly suggesting that the Fed should be cutting rates quickly if that's their mandate. Despite the economic weakening, the market has actually been strong. So should we be preparing for a downturn? Not necessarily, okay? Stocks are likely to still have room for upside, in my opinion, given that the bullish structure that we've had for a few years is still intact. The key moving averages are still basically trending upwards. And keeping in mind that markets are not a rational predictor of the future. For instance, in the 1920s, stocks soared heading into the Great Depression. But when that recession hit, the market quickly reversed course, and we ended up in truly a horrible, multi-year, decade-long doldrums for stock prices. And it was obviously awful. I don't expect this to lead to a depression where we are right now, but a recession would likely, in the tail end at least, represent a significant pullback for stocks. Similarly, in 2009, the market was crashing, but this was just months before the recession ended. So in other words, we were deep into a recession before the market started to pull back significantly. So this shows that the market often misjudges turning points, only to reverse course once reality does set in. And so, who knows? A similar scenario could be playing out today. I do think there's a couple of key differences here, given the amount of money that was pumped into the system during COVID, the huge amount of cash that's sitting on the sidelines right now, meaning money that's sitting in treasuries, right? We've never seen this much cash sitting on the proverbial sidelines as we do right now. That creates a lot more flexibility in the marketplace. If interest rates really are being pushed down and the yield curve flattens, people aren't going to have a lot of options, right? If they're going to want to hold cash, that cash is going to erode in value if they can't invest in 5% yielding assets, low risk assets anymore, right? So that could force a melt up in stocks as well at some point, okay? So sorry for the long explanation, but I think it's important to understand that we are at some type of inflection here where I do think significant liquidity is going to come into the system in Q4. It may delay, we may not see a huge run up right away, but I do think at some point in the next 12 to 18 months, we are going to see a melt up in assets. We're going to get a capitulation at some point, in my opinion, and we'll probably get a significant pullback, especially if we are in the final phase of a recession, as historically has shown. It may not be as deep a recession, just given the amount of money we've already pumped into the system over the last few years, and given the amount of cash sitting on the sidelines. The biggest problem the government has, in my opinion, is related to what we're going to talk about next, which is yield curve inversion and the debt, right? So, while the government desperately needs interest rates to come down to effectively reset the debt on our balance sheet in the coming year, the problem is that less people are willing to buy our debt and at lower prices especially. And of course, what that means is that interest rates will have to go up as opposed to come down in order to get others to buy the debt, with the short-term exception that the largest buyer of U.S. Treasuries is probably going to remain the Federal Reserve, which also limits its flexibility in terms of raising and lowering interest rates long term, because it will lead to higher inflation when they do that, which is again against one of their mandates. So they're in a bit of a catch-22. All right, I want to talk about this concept of yield curve inversion, which I've mentioned a few times on Money Talks in the past. What is yield curve inversion? What is this mumbo jumbo? Why do you hear it talked about by the talking heads? Why should you care about it? What does it mean? What are the implications in the coming weeks and months for yield curve inversion in the United States? Okay, a yield curve is basically a curve that shows you a plot of short-term interest rates versus long-term interest rates. Think about a mortgage, right? If you take a 30-year mortgage, you expect the rate to be higher than a short-term, let's say 10-year mortgage. The risk on a 30-year mortgage of non-payment is higher. The money's being put to work for longer. So the person putting the money to work expects to get a higher return. That's just the way it normally works. A yield curve inversion occurs when the opposite happens, when short-term interest rates become higher than long-term interest rates. And again, as I said, normally the yield curve slopes upward, reflecting this idea that investors expect more compensation or higher yields when they're lending money over a longer period due to the increased risk over that longer time frame, right? Such as risks due to inflation, economic uncertainty, changes to the job market, your inability to pay in the future, et cetera, et cetera. However, when the yield curve inverts, it signals an often significant shift in investor sentiment. So what does that mean? Right. So investor expectations of slower economic growth can often happen when the yield curve inverts, right? So this can indicate that investors expect slower economic growth or even a recession. They'll often seek the safety of long-term bonds, which drives their prices up, which lowers their yields, right? So while short-term rates remain high, due to current market conditions or central bank policies, right? So historically, these yield curve inversions have been a pretty reliable predictor of upcoming recessions. Inverted yield curves have preceded almost all recessions in the US over the past several decades, making them a very key indicator watched by economists and investors. So why is yield curve inversion bad? Again, number one, recession risk, which we just talked about. Number two, credit tightening. So in the short term, right, banks borrow at short-term rates and lend at long-term rates. If short-term rates are higher than long-term rates, their profit margins shrink, making them less willing to lend money. And this tightening of credit can further slow down economic activity, which creates a negative feedback loop, which can be, obviously very bad. An inversion can then create, again, this negative feedback loop such that the investors lose confidence in the economy, leading to reduced investment and increased demand for safe assets like government bonds, which worsens the slowdown. Again, the negative feedback loop inherent in negative investor sentiment, meaning what you believe to be true or believe to be happening can then become a self-fulfilling prophecy, which makes things worse and worse and worse, hence the term negative feedback loop. All right. So just to summarize, so a yield curve inversion is often seen as a warning sign of an economic downturn or recession. It can lead to tighter credit conditions and reduced borrowing, and it often reflects investor pessimism about the economy's future growth. Now, after all that explanation, why am I telling you all of this right now? We're currently in the middle, or hopefully the end, but in the middle, in the worst case scenario, of the longest yield curve inversion since 1929. This could indicate that a major economic downturn is coming based on everything I just explained to you, right? The current yield curve inversion has lasted over 750 days. So in other words, it's been happening for over 2 years. This is a very concerning development because market drawdowns have a positive relationship with inversion days. In other words, if you plot the number of inversion days against the market drawdown, right, in the coming recession, the shorter inversion leads to a shallower market decline. But when the curve is inverted for a long time, like it is now, it has often ended in major market crashes like 29, 74, 2008. This happens because of an extended period of tight monetary policy, which is exactly what we've been dealing with. It's a little bit different now because of COVID, but because of the amount of money that was introduced to the system, we literally increased the money supply by 25% during COVID, but people generally don't care as much about the past as they do about the prospects for the future. So today's inversion, now over 750 days, therefore puts us at risk of a big market decline in the next recession if history is any guide. All right. And as I said, this is the longest yield curve inversion since 1929. All right. Okay, so obviously, time will tell, but I think it's important, especially for those of us here on Money Talks who care about these things, to understand the implications for yield curve inversion, for the economic data, and not just treat it like economic mumbo jumbo that's only accessible to the so-called talking heads experts, but accessible and usable by all of us as well. All right. Let me know what you think about that explanation, and if you want to see more explanations of some of the key kind of terms and ideas in the macro world, and we'll spend more time on it on Money Talks. I want to switch topics, talk about crypto for a couple of minutes, and then get into some tech news, and then we'll call it a day. Yesterday, today's Thursday the 5th when I'm recording this, yesterday Uniswap Labs posted on Twitter, their head of legal posted that today Uniswap Labs resolved a CFTC matter. Now, Uniswap is a trading platform running on Ethereum. It is what we call a DeFi platform, or decentralized finance platform. And DeFi basically, the DeFi market or industry aims to reproduce the banking and investing markets on top of crypto, which in theory has the advantage that it's open 24/7, has no borders, has no off switch. Well, if it's open 24/7, has no borders, and has no off switch, how can they be settling a matter with a company? And so we'll get into that in a second. But yesterday, Uniswap Labs resolved a CFTC matter involving a fraction of a percent of trading through their interface of a handful of tokens that were being traded. They paid a $175,000 fine in their kind of no standard, no admit, no deny settlement. And their statement was, we are glad to put this to rest and stay focused on building the future of DeFi for all. Now, as I understand this, I have not dug in deep. There's a CFTC statement on their website where they said that Uniswap Labs contributed to the development and deployment and deployed versions of a blockchain-based digital asset protocol that offered to non-eligible contract participants, which in English means basically to everyday retail investors, not just to super wealthy people or institutional investors, and also outside the US, of course, the ability to trade digital assets through the use of the Ethereum blockchain, which is exactly what this DeFi protocol, Uniswap, is actually doing, right? So anyway, the stated order recognizes that Uniswap was cooperating, but effectively what they're saying is that they illegally offered leveraged or margined retail commodity transactions via a decentralized digital asset trading protocol. So there's a fine distinction here, right? The CFTC, I believe, realizes that they can't regulate the protocol itself, right? Because it has no off switch. If you shut down Uniswap Labs, the protocol itself would actually still be running, right? Which is an important distinction, meaning it's almost impossible for a regulator to regulate a protocol running in the background, right? Again, no off switch, no borders, no whatever. However, the user interface that uses the protocol is a different story. If you have a web interface or a mobile app, right? Somebody is deploying that has an off switch. You can shut off a web page, you can shut off an app. And because generally speaking, those services are considered under the auspices of the Commodity Exchange Act, right? They would have to either get appropriate licensing or filter out non-eligible contract participants. And this settlement claims that for however reason, probably because they were using VPNs or other software that the Uniswap interface wasn't easily able to identify, those people were able to use the service even though they were US persons who were non-eligible contract participants. And so according to the statement, it was a very tiny number, and they apparently wholeheartedly cooperated with the CFTC, which appears to be why the fine and settlement was generally fairly benign, which is pretty par for the course for the CFTC, who has taken a more reasonable, seasoned approach. I don't necessarily agree personally with this approach, but it's certainly on the surface more reasonable versus the SEC approach. It's still, I would say, regulation by enforcement, but at least under those guidelines, you can kind of understand the logic of what they're doing. What they really should be doing is giving us very clear guidelines as it relates to crypto, but since that's not going to happen, at least it's a little bit more nuanced versus what we're getting from other regulators, and you know who I'm talking about. Okay. So I suspect this isn't the last of Uniswap. We mentioned Polymarket before. I think of Polymarket as a DeFi kind of betting market where you can basically bet on the outcome of real world events. This is ripe for regulators coming after them because they are using, again, web-based interfaces, which would then either be available or not available to different countries. And I believe that Polymarket is not available to US citizens. I've never tried to use it. I don't generally use a VPN as much as I should, but I guess I could try it. I'll report back if I'm able to get through. But my guess is that they block US persons because those betting markets would be considered illegal by the CFTC or gambling regulators or some combination of both of them. Okay, so but that doesn't change the fact that I think Polymarket is super interesting and is a big deal, and it's one of the killer use cases for crypto that I've seen so far. All right. Ripple is in the news. They've announced that they're launching a USD stablecoin, which is coming in weeks, according to CEO Brad Garlinghouse. The RLUSD token will be fully backed by US dollar assets, tested with their enterprise process, and will operate on both the XRP Ledger and Ethereum blockchains. Pretty cool. I don't know a lot about the Ripple business right now. I know that they work with a lot of international banks, and they're heavily involved in trying to build out a large payments and money transfer business over Ripple, and I believe they've had some success particularly in non-US markets. So I hope that their foray into DeFi ultimately proves useful and helps propel the space forward. My understanding is that Ethereum compatible smart contracts, I assume using Solidity, will be launching on the Ripple platform or XRP platform, so that the ERC20 model, for example, which is how you implement stablecoins, will also work on Ripple, which is pretty cool. Again, I don't really have a strong opinion on Ripple one way or the other. All these things are software. Use them or don't use them. That's how I look at it. But I've always said to you, competition is a good thing. The more developers we have working on interesting things in the crypto space, the better off the crypto space will be, the more it will flourish, and the more interesting things will ultimately happen. Okay? All right, so we didn't talk too much about prices last week. Crypto, it's been sideways summer, as I said. It looks like sideways summer continues. We're at the bottom of a 6-month channel for both Solana, Bitcoin. Ethereum is looking a little bit more bearish, but Bitcoin, Solana are really touching the bottom of the 6-month channel. I'm looking at the Solana price chart right now. It has touched this price point of 130, like a dozen times, but more or less it's created the bottom of this channel 1, 2, 3, 4, 5, 6, 7 times in 6 months. And if the channel holds and it goes full and it goes up, similar to how it's done it the past 1, 2, 3 times, we could literally see a 50% price gain in Solana in September. Then things become interesting. What happens if Solana hits 190 to 200 again, right? Like it's done a few times before since March. I think this would be the fourth time, more or less the fourth time in the channel that it hits that 185 to 195 price range. I think if the economy is going south and the Fed and the banks and the Treasury are indicating significant pumping of liquidity into the US system, we could finally break above that channel. Okay? If it's more or less business as usual, right? I think, we could basically be stuck in that kind of large 50%-ish sideways channel again for a while. At some point, we are going to break higher. We could also break lower, into the 100 range before we get higher. But at some point, in my opinion, it is going to go significantly higher. And I think Solana will outperform Bitcoin. I think eventually even Ethereum has a very good chance of outperforming Bitcoin. It is still the leader in DeFi, although its usage relative to Solana has come down significantly in the past few weeks. Okay, so still on for we're still game on for sideways summer for at least a few more weeks, in my opinion. I think the kind of most important date for me is going to be about 2 weeks after the Fed meeting. There's a really good chance we're at the top of this channel, and we'll see if we move on to new short-term highs, which for Bitcoin would put us in the 75K range. For Solana would put us in the 225K range. It's going to happen. Is it going to happen in September, October, or going into Q1, Q2? I have no idea. It doesn't matter that much to me in principle, because my time horizon is forever. But I think it's interesting from a macro perspective to understand where all of this is going. Okay, so we've talked about crypto, we've talked about market prices. Let's finish with a little tech news. So I am a big tech fan of if you're building a gadget and you can't find somebody to sell it to, always give me a call, because I'll probably buy it, or probably I've already bought one. You may know that DJI is the world leader in drone technology. They just announced today, actually, a new palm-sized drone, which they're going to put on the market for $199. I can't wait to try it. I love using these palm-sized drones because you can take amazing pictures when you're on vacation. And the smaller they get, the quieter they get, the less intrusive they are into life. I don't like it when they're loud and intrusive when you're in nice and beautiful and quiet places. But if if they're quiet-ish, it's okay every once in a while, and I think we're really heading in that direction. And look, we don't really have a good drone maker in the West right now that I'm aware of. Clearly, Shenzhen-based DJI owns the market. Nothing wrong with that. I mean, it's just competition. Would love to see Western-based drone makers, but I just don't think we have the expertise to kind of miniaturize drones right now in the U.S. Maybe somebody will figure it out. But in the meantime, I can't wait to get my hands on one of these. What is it called again? The Spark. Oh, no. The Spark is what they introduced in 2017. Did they have a name for this one? I don't see it, but anyway, it's a DJI-based drone. Sorry, it's Neo. It's called the Neo. That makes sense. It's new, so they're calling it Neo. All right. I'm not sure what they're going to call it in a year, but for now they're calling it the DJI Neo. We talked about iOS 18, which now seems to be getting close. And Apple should be revealing iOS 18's exact release dates next week. They have their yearly fall or out of summer going into fall event. And I suspect that sometime in September we'll get a release date for iOS 18 along with the new iPhone. And there's a bunch of cool new stuff going on that I've talked about. But the most important thing, and I'm hearing a lot of really cool feedback on the integration, is ChatGPT and AI integration into the iPhone and into Siri. I interact directly with ChatGPT using voice all the time. I use it for business. I use it for personal. You name it. Give me a use case. I've figured out and have tried it most likely at this point. I develop simple web apps when I'm traveling to do simple things. I treat it like an exec coach sometimes when I'm thinking through decisions. I ask it to remind me about advanced macroeconomic concepts sometimes. We had a discussion recently on nuclear energy and where all that's going, and modern technology, reactor technology versus historical. It's really incredible. And I can't wait for it to be able to deal with a lot of the day-to-day kind of administrative things in my life as well that waste a lot of my time. And so I think this is the beginning of that with Siri and iOS, and then I think Qualcomm and Google is moving in a similar direction with Gemini, which I think is also fantastic. I think Claude is fantastic. Claude seems to be the leader in AI for developers as well. Its ability to generate code is remarkable. Qualcomm said that it's working on mixed reality smart glasses. Also, one of my favorite gadget concepts, I'm sure you've seen the Tony Stark glasses. You've seen other examples like in Minority Report, which was, kind of a panel-based glasses as opposed to wearing, but same idea. And I think these are coming. I think we're one generation away. We've seen an example of what Meta's been able to do with their Facebook integrated, Llama integrated glasses, which I think are pretty cool. I think we're going to get a hybrid between the low end, let's call it the low end Meta glasses, and the high end Apple glass slash headset, which is obviously very bulky and amazing what you can do with it, but you wouldn't want to walk around town with an Apple headset, okay? But you wouldn't mind walking around town with your glasses, especially if they don't look super bulky. And I think that's where this is headed. So really excited about AI and where this is all going. I will continue to talk about it on Money Talks every week. I think it's one of the integration of AI with crypto is something that I've also been spending a lot of time on. I'm not really ready to spend too much time on it on Money Talks yet, but most likely will in the coming months. And I'm pretty bullish on where this is all going and how AI and crypto are going to mesh to basically become more or less the transaction enablement platform for the internet itself. And like I said, we'll have more to say about that in the future. Okay, so we'll wrap there. This has been another fun, exciting episode of Money Talks, where we bring you all things macro, micro, techno, crypto, and I look forward to your feedback. I've gotten some really good feedback in the YouTube and in the X comments. People are really excited that Money Talks is back. Give us your comments on what you want to hear about, any crypto projects, any technology projects, any macro concepts you want us to explain. We do this for you. I don't do it for my health. So let us know what you want to hear about. And we will see you next week on Money Talks. Have a great weekend, everyone. All right, so I promised at the end of Money Talks I would give you an update on what's happening with Abra. Last week we talked about Abra Private, which is Abra's service, registered investment advisor service for high net worth investors, financial advisors, trusts, family offices. This week I want to talk about Abra Treasury. Abra's Treasury solution for family offices, corporations, nonprofits, which includes custody, trading, borrowing, and yield services. These solutions are offered through Abra Capital Management, our SEC registered investment advisor, via a separately managed accounts model where you retain title and ownership. You, meaning the company or entity, retains title and ownership over these assets that are deployed, and they are independently verifiable on chain. Okay, so corporations, we offer treasury management services, which can optimize cash or stablecoins or crypto assets held on your balance sheets, with the goal of maximizing your treasury through yield, mitigating inflation risks, gaining liquidity through borrowing. We've helped nonprofits with treasury management, which can result in increased financial stability over time, the potential for greater funding towards your mission and programs. And lastly, family offices. We help family offices generate a yield on their digital assets in a secure and compliant fashion. You can borrow against holdings off of your balance sheets. So in other words, if you're holding Bitcoin in the family office, you can borrow against it in dollars. And we can create customized digital asset strategies for enhancing long-term wealth preservation. So to find out more, go to abra.com. You can go to Abra Treasury, click on Get Started, contact the Abra team, and we'll get in touch with you and help you understand all of the details for all of the Abra services, Abra Private, Abra Treasury, and also our Abra Prime service offering. Thanks, folks, and we'll see you next week on Money Talks.